In today's video, we're talking about buying call options versus selling puts and which one is better when it comes down to the numbers. Yes, there is a mathematical way that you can plug a formula in and calculate your expected return for which one will give you the best chance of success. We're going to dive into that and show you 3 easy steps that you can plug in yourself to a spreadsheet and calculate the trading averages for your trades. So step number 1 of this process is to find a stock or a company that is in a bullish or upward moving trajectory on the chart. To do this, let's hop over into TradingView and see what we got. We are checking out AMD right here, Advanced Micro Devices, and you can see that this stock has popped off recently. It has had a nice strong candle upwards. So what we want to do first off is say, is this stock ready to run further? Based on the volume bars moving up here, based on this candlestick, that is a huge bullish candle here, and the other technical analysis on this page, I'm saying yes. So now we have to figure out where this stock may go. And doing a little bit of quick technical analysis here, I'm going to just draw this trend line in, connecting these top end points right here. Just looking to connect the top of these red candles right there, that one right there, one here, one here. That's our kind of trend line that we just broke above, which means that this candle, in my opinion, is off to the races if it can hold above this line, which means we then go and set our top end price target. And I'm going to put at the next level of resistance in terms of where the candles kind of start to group here. And that right there is back in July of this year. We're going to put a marker right there, and that's going to be our upwards limit or our target price for the next part of this exercise. And we're going to do one more thing inside TradingView right here. We're going to go in here and just do the ruler tab and say, hey, from where this is at 108.4 right now, we're going to click on the ruler tab and go measurement up to this line right there. And we can see that it is about 10, let's call it 11% of an upwards move. We're going to use this information in the next part to populate our trading spreadsheet. So inside of Google Sheets here, I've created a spreadsheet for you to use, and I'm going to share the Excel formulas once this is all filled in so you can see it for yourself. What we're going to do here is look at the expected value at the end. And these 2 numbers are the key numbers to look out for. What we want to see is which one of these is bigger. Is it going to be for buying a call? Is it going to be for selling a put? Remember, you make money with both of these strategies if the stock goes up, but in different ways. So now we can go about putting some information into this chart here and filling some of these columns in. We know that we want to buy a call or sell a put on AMD, so let's get the current price of the stock. To do that, we can type in the nice little formula here, and I'm going to cheat a bit here and have this come over from a different spreadsheet and just pop it in there for you. Google Finance, NASDAQ, AMD price. That's going to give us the current price of AMD just for reference right there. Then we have a strike price we want to pick. And I've decided to go for the 100 strike. And let's go to Interactive Brokers now to see the options pricing for the 100 strike at AMD. So I've decided to go for December 15th, 44 days out, because you always want to give call options some time to work in case the stock doesn't move in your favor. You have 44 days for this to work. Theta isn't going to chew out your position. We're going to look at the 100 strike price right there and take the middle value between the bid and ask here on the call side between 1185 and 12. Let's call it 1190 for kicks and giggles. And let's go 1190 and put that in our spreadsheet. So under our cost to buy or our cost to purchase this call option, it would be 1190 or equals 1190 times 100 because there's 100 shares in every options trading contract. Boom. And you can see that the expected value number did change, but it's not a final number yet in this equation. We still have areas we need to put in some data, profit if the stock goes up, and the probability of success. But before we do that, let's get this profit to sell column done for selling the same put at the $100 strike price. Flipping back to Interactive Brokers, we can see that 100 strike price over here on the put side, we have the difference between 310 and 320. So 315, here we go, put that in, equals 315 times 100. You can also just put in 315 if you want to. This is just to show you that every contract is worth 100 shares. And I've just linked this profit if the stock goes up, because if the stock does go up and you're selling a put, you just get to capture that premium a little bit quicker. You don't actually make any additional money like you do when you're buying a call. So those 2 are linked right there. They're just referencing each other. Now, just before we get to the really, really fun part, which is filling in this data right here. I know you want to see it. You want to see what the profit potential is, the success probability is, all that right there to get this final number. Let's go into this one because it's a lot easier to calculate for us when we're selling the put. So Interactive Brokers, make sure you're selling this put option, number 1. We're always going to be selling puts and then buying calls. That's the bullish strategy setup. Our limit price is in there, which is great. We go to advanced now. And this is where we get the key data. Margin performance. Boom. And you may think this is a lot of work, but it's really not if you want to see numbers. It is a quick, easy thing. The more you do it, the more you're going to be able to do it quickly. And you're going to see right here in this area right here, Max return, 310. 71% chance of getting 100% profit. That's a pretty good deal. Okay, profit probability overall, 78%. We just want to take this 71 max return, looking for the maximum amount that we're going to get back. 71% chance, let's put that into our spreadsheet in Google Sheets. So our probability of success that we just saw in Interactive Brokers, 71%, which means, drum roll, 29% chance of this not working out or failing, which is just calculating by taking this number and subtracting 1, as you can see there. So our expected value now is complete for this area right here for the selling of the put. We have an expected value on this trade of $223.65, meaning if we were to sell this put option today, given where everything is at in the market, the price, the strike price, the current price of the stock, the odds right now that Interactive Brokers is telling us, we have a expected value in this trade of making $223.65. Not bad, right? Okay. On the flip side, we now have some work to do to get this profit if the stock goes up. We need to do two things. Number one, go back to our chart and see that technical analysis level again. For reference, we had this drawn in at the 119 level, okay, which is roughly a 10%, 11% climb. And this is where we think that the stock price is going to go. It's not guaranteed, but this is how we build in our probability of profit for this trade. So remember that 11% area right there, which is where we think this is going to go based on our technical analysis on this chart. We go back to Interactive Brokers and say 11% rise. Stay with me here. We go back into our position here for buying this call option, this 100 call option. Yep, we're going to buy it. We're going to do the same thing, okay? We're going to make this price the mid between 1185 and 12, which is what we said was 1193 right there. Okay, go to advanced again, go to margin performance, and now the fun begins, okay? We have a profit probability there of just being profitable, not max profit, because if you're buying a call option, as you might know, the profit is infinite. It could go to whatever you want it to go to. The stock could keep going up and up and up. There's no limit. But profit probability is 43%, which is great. That means there's a 57% chance of this trade being a negative or losing trade, which is okay. But again, we want to go down here and say, hey, if the stock price goes up by 10%, okay, from its 108 to that 119, which is about that 11% gain that we had, you're going to be making that $900 rise in profit and loss. So you're up $900. We think based on our technical analysis on the chart, this is a legitimate level that the price can go to at 119. So we're up there, and we know that if it does, our profit's going to be about $900 cold hard cash, okay? So now we have to figure out just one more thing to get this expected value number to be correct. So here's the fun part. We now have to figure out the probability of this $900 being a realistic target. We know that this is a target on our stock or technical analysis target, but how likely is it that the price actually gets there? So to do this, I like to turn on one more indicator in the charts here. It's called the Ballinger Band. I'm going to put it on right here. Ballinger Band, just to get a little bit more depth onto the chart and see where we're at in terms of technical analysis. This area right here, so we would be going up and above this little line right there, which is telling me that if the stock price goes above this line, it's a 95% chance that's going to come back in between this blue line at the top. We're on the uptrend. We think that this is a potential move higher, but these Ballinger Bands represent standard deviations and saying that 95% of the time, the stock price trades in between this blue line right here. I'm going to make this red for us. So it's in between these lines 95% of the time. It can go up and it can move. These blue lines will move as the stock price moves, which is great. However, if the stock was to continue to run up, this blue line is going to continue to run up, and it's going to open up as the stock price moves. That can happen. But the likelihood of it happening in this kind of magnitude right here is maybe not a 40% chance, maybe not a 30% chance. I would say it's probably a 20 or even 15% chance. So we can go back then inside our Google Sheet and say, hey, I think it's really likely to be a 10% move higher, and we put in 10% of this happening. And then we can see that this trade, given the cost to buy and the probability of it going up to this level, is not an expected value trade that we want to take on right now. But if we think that the probability is closer to a 20 or a 30% market, this will impact the expected value greatly. But you can see in this example, it's actually a really high probability of success that you need to have. Even if we go back to Interactive Brokers, back into our advanced tab, margin performance, and say that there's a 43% chance of just being profitable overall for the trade, and put that 43% number in, You guys can see it's not a great expected value. It's actually negative for this trade just because the cost to get into this trade is so prohibitive and so high. Given that, and the other thing that selling puts has going for it is that there is a probability of success up around 71%. So if you were going to make this trade and you were going to target $900 in terms of your profit for this trade, you could do this, but your expected value is actually negative. It's much safer in this scenario to take the 71% chance and sell the put option and make 315 in terms of your overall profit. Not as much, but greater odds. Now, if these variables do change and your probability goes up for the call and the cost to buy goes way down and the profit goes up, this will all have an impact on the expected value where it may be better or in your better interest to go ahead and buy that call option. However, in this scenario, it is not the case. The expected value greatly favors the selling of the put. There's also one other huge component to deciding if you want to buy calls or sell puts, and it comes down to your account size and how much cash you have in your account. Buying calls are relatively cheap, whereas puts are not. To see what I mean and more depth into if you want to do this with a small account versus a large account and which one works better for your account size, make sure you follow my channel and check out this video right here.